Yeah, one of our money topics, and this is something that we've experienced, Leo, but
100%.
Silicon Valley Bank, their collapse is really scaring startup funding, right? VC is
yes.
really, really slowing down. They're getting a lot pickier. So we're going to kind of talk about New York Times actually put out an article on that literally says Silicon Valley Bank collapse chills startup funding. So we're going to break that down. Let's dive into this, Leo. Let's get going on the money topic. I know that was one of our big ones here, and just because it's pretty fresh on our minds, we just had some really good meetings with VCs this week, and we had some doozies with VCs this week. So let's talk about Silicon Valley Bank and how that collapse has impacted startup funding.
And guys, we're going to give you a kind of an encyclopedia of experiences and what's going on with venture capital in 2023. And for sure, years ago it was easier, but let's dive into this article. So this is a New York Times article. New York Times used to be the master of the universe when it came to news reporting and being objective and pushing people to the edge. Things have changed a little bit over the years, but it seems like there's been a return to that. And so we certainly hope that that's where they're going. And here's an article that says Silicon Valley Bank's collapse chills startup funding. 2 weeks after the bank failed, the fallout has hit the startup market as investors pull back further and fear has risen more. Jonathan Nilsson had lined up commitments for, Jonathan Nilsson had lined up commitments for $2 million in new funding for his financial technology startup. Oh my goodness, this sounds familiar. HR Capital from two investors last month. He was aiming for $2.5 million, and he thought securing the rest would be perfunctory, like no-brainer easy, right? Then 67 investors, holy cow, 67 investors turned him down in mid-March. His initial investors backed out too. Mr. Nelson was initially confused by the cold shoulder, but 2 days later when Silicon Valley Bank, the most prominent bank for startups and venture capital firms, collapsed after tech investors and startups set off a bank run, it all made sense. I was scratching my head saying, why did they just ghost me? And then the bank run happened. I was like, they're terrified. And the same realization is ripping through the startup world in the wake of SBV's sudden failure after a harrowing 2022 when the easy money for startups dried up, leading to slashed valuation, lower. And so that's what happened. Like in 2019, 2020, and 2021, there was a lot of money that poured into these new startup companies or startup companies that had been going for a few years. And it was kind of like they were all in it together and they were very optimistic, but they missed some of the realities. You know, you and I have talked about this for years. How is it that some of these startup, venture-backed companies can literally bleed money year after year after year after year, and then they still get another 10 million, they still get another 20 million, they give it another 50 million, and they're growing, they got a lot of employees, but they literally, like they earn maybe $1 of income and they might lose $3 at the end of the year. So if their revenues are $1 million, they might lose, honestly, it's probably more like $5 million. Let's call it $3 million. So literally I make $1 million, I lose 3. I make $5 million, I lose 15. If you're a company like Lyft and some of these others, I lost $500 million. Like, all these companies losing so much money. So at some point that had to come to roost. And what happened was these high interest rates came in. And now if you're an investor, all of a sudden it's much more complicated. It's much more expensive to fund your business. And so if you're putting your money in there, you're not quite as excited, because at the end of the day, it's how much can I make on my money? And so if you're an investor, you could put it in tech companies and hope that you're going to make it back. Sometimes it disappears. A lot of the times it does. Or you can put it in bonds and make 5 or 6%. And so that's been the issue for investors. And then you have high interest rates that have complicated everything from there.
Yeah, I mean, it's one of these things where it was about time that these VCs, these investors, got a little bit smarter. And I think part of the problem was that so much new tech came out all at once, and they were all getting pitched on the exact same, different VCs were getting pitched on these same ideas, but because it was such new tech, it was their first time seeing it, and they're thinking, wow, this is awesome. And all of a sudden there's a million companies all doing the exact same thing, and they've lost their competitive advantage, and they're all starting to fail. And so that's where VCs, especially in the fintech space, they're really, really tightening up. And, some of the questions that they had asked me, I was like kind of shocked and floored by how they were coming just out of left field there. But I mean, it's one of these things where I hate to say it, but I get it, right? I understand. I'd love for them to be throwing money at us like crazy because that would be awesome. But I understand why they're finally starting to tighten up, because so many of these businesses are just failing and losing money. It just doesn't add up.
And so then the other thing that starts to happen is a lot of these tech companies are going to go out of business, and the only way they're going to raise more capital is in what they call a down round. And a down round means you go to the venture capital firm, you're like, yeah, we think we're worth this. And they look at their books and say, yeah, you lost a ton of money last year. You're growing a little bit. Actually, instead of saying you're worth, $50 million on paper, we're going to say you're worth $25 million on paper. And so if you need another $5 million, now we're going to take up half of your company instead of 25% of your company. And those are things that are real and that are happening. And then the other thing that happens is the employees have their ownership shares, and they think their ownership shares are worth a little bit. And so if you're a good owner, you're actually going to look at it and say, we effed up, we didn't do the job, and you're going to have to give up more of your ownership as an owner to keep morale up with your employees. And that's what's happening with a lot of these down rounds. So here's what's interesting. Like years ago, we have a good friend, right? And he was able to raise money, what was it, 3 years ago, I think. Yeah. And he raised $1 million. And he really raised it off of an idea. He didn't have any sales. It was pre-revenue. And that's how easy it was to raise money a few years ago. And then you fast forward to today, and if you don't already have a built company, it's very difficult. So for us, we've been serial entrepreneurs. We have a company that's now done over 8 figures in revenues and millions of dollars a year and 25, 30 full-time employees. And so for us, it seemed like, well, geez, we've got things figured out. We've got this software we want to, add to the marketplace that's going to solve a lot of problems for a lot of business owners. It should be easy for us to raise, a couple $1 million. And even where we're at, it's been complicated. And here's what's interesting. If you're out there and you've been thinking, or maybe you're trying to raise venture capital, or you've been looking at doing, you're wondering, you're curious, what does this look like? Here's what our experience has been. So we went to this FinTech meetup in Vegas, went with one of our other partners, Bo, there. It was interesting. We met with all these different groups there, and we learned a lot, pitched to some of the venture capitals. And, in that event, in that space, you literally have 1,000 people in a room, and it's kind of like, well, we'll talk seriously afterwards. So now afterwards, we've been connecting more seriously with venture capital firms, and you'll meet with one firm, and the dude will take you in one direction to say, you should do this. And I'm not going to invest, because I don't it's not a perfect fit for us, but I think you need to do this. You're doing this all wrong. And so we listen, we're like, oh, okay, cool. We need to go this direction. And then we meet with the next guy, and he's like, no, actually, we like what you're doing. You're doing this. It's not a good fit for us, but, it looks like you're going the right. And then another guy will have a completely different take. And so you get you're just pulled in all these different directions, and you're just not sure, well, how do we navigate that?
Yeah, I mean, I've just started to jump on these meetings with you and these pitches with you, and it's blown my mind. Literally, we'll do 2 in the same day. And this guy's saying, oh, I can't invest in this because you're commingled with another business. And then the next guy's like, I love that you have this other business here that's kind of flowing in. And so my big takeaway is, look, you need to figure out your direction, where you're going, who you are as a business, and your business better than anyone else, and stick to your guns. Not every single VC that you pitch is going to like it. Some of them will. I mean, obviously, if you're getting told the same thing over and over, probably time to pivot. But for me, Leo, it was good to see that we are right on track with some. We're not on track with others. That's okay. If they're denying us or rejecting us for that, we probably don't want to work with them anyways. And you kind of need to have that mindset when you're trying to raise capital, because you're going to get rejected a lot.
Yeah, I completely agree. And for us, it's a little different. Like, we aren't just theoretical. We think this is a good idea. I mean, we've served thousands of small business owners, and we've heard what their struggles are. We know what their struggles are. We've worked with their coaches and their consultants and their accountants and heard from them, gotten their feedback. And so at some point, like, we have done the due diligence, and we're going to do more to figure out what the market wants. And so I think you're right. I think we stick with our non-negotiables. We're able to accommodate and be flexible on a few items, but overall, like, the vision needs to stay the same, and we need to push forward, learn where we can. And then I think at the end of the day, that's where you've got to be an entrepreneur. You've got to be scrappy, and you've got to be, hey, if I need to raise capital, sell a property here, put a little bit of money in there, maybe it's not built out as far as I want, but I can add another feature or two, and I can go out and get we haven't even marketed my figures, and I think we're at 106 paying subscribers here and 300 like free ones. But hey, what if we get 1,000? What if we get 5,000, 10,000 on our own? Then they'll come at our door begging to give us money, and then we can be really selective at that point. So I'm really kind of leaning towards that. We'll keep on knocking on doors. But if you're in the venture capital and you're trying to raise money, I think those are things you should consider and try to figure out and get a minimum viable product that's pretty good, that solves some problems, and then you can kind of do it on your own terms. And so I guess here's for sure what's true is right now is probably the most difficult time to raise capital that there's been probably in the last decade.
Yeah, I mean, absolutely. And the biggest thing from hearing feedback from all these VCs, Leo, is you need to clearly define your competitive advantage.
Yeah, that's true.
Period. Like that's what it always comes back to, because chances are what you're creating already exists in some way, shape, or form. It's how do you do it better, and how can you present that to a VC? It's like the McDonald's thing, right? There's hundreds of thousands of places selling hamburgers. Why is McDonald's so much more successful? You need to be able to define that for your product.
And that's where it's good to be like, hey, we're going to stick to our guns. But then when you also hear, we've heard multiple of them, hey, you're not really as clear in the solution you're providing. And so that's been good for us. And that's been good for us to step back. And you're right. We're not articulating our message and our solution good enough. And thanks for pointing that out. Now we're going to have a much better, concise message and the competitive advantage, the value, the solutions, benefits we're delivering to our partners and to our end user customer of our fintech app. And so that's been really good. And so I think that's a good thing to look at wherever you're at with your business, right? If you have some haters, you have some people talking crap, some people, an angry client, it's good to listen. And where are they right? Step back. Hey, you know what? They are right about this. We do need to do a better job. And then at the same time, if you have others that are they all have these all wild different things that don't sort of correlate and come into something that you should change, then you shouldn't look to change those. And so it's kind of give or take there. But if you're seeing a common issue come up, that's obviously something you need to step back, be honest, and fix, and vice versa. If it's not that and someone's just out in left field here, you can kind of take it with a grain of salt and then move forward. So very interesting. That's what's going on with venture capital. And now the next question is, well, how can small businesses find safety before the next bank crisis? And this is also another New York Times article here. And so it says financial advisors recommend that business owners examine their accounts now to ensure that they are protected in case of a future bank failure. And I believe Warren Buffett said last week, good old Uncle Warren, said that it's very unlikely if you have money in a bank and it's more than the $250,000 that's insured from FICA, or the FDIC, not FICA, FDIC, that you have anything to worry about. The government's going to back that up. So that's what he thinks. But here's what this article says. It says the collapse of two regional lenders, Silicon Valley Bank, SVB, and Signature Bank, last month caused a ripple of panic among small businesses across the country as owners watched the news unfold and wondered whether their assets were safe, even if their deposits were not in one of the failed institutions. Now that the panic has begun to subside, advisors are recommending that small businesses examine their accounts to determine the level of risk. Basically, you have your money sometimes in these smaller regional banks, credit unions, et cetera, and it's insured up to $250,000. But if you have more than that and you're a company out there and you've got a bunch of employees, or you just got maybe a big ERC check refund that you got deposited and so forth, and you're thinking, where should do I need to worry about my money? And so the funny thing that's happened, Ty, is, and this has been unfortunate, a lot of these regional banks, business owners have been proactive. They have been scared, and they're like, maybe I better take my larger amounts of money from my business or in savings, and I should move that into one of the big ones. And one of the big ones, and I looked at, there was this list of all the safest banks in the country, and number one, what do you think number one was?
I have no idea.
It was Chase.
Yeah.
It was Chase. That's where we have our business accounts, and Jamie Dimon has been running Chase for, 15, 20 years. That guy's been doing it a long time. And so Chase is the least affected they in terms of these bonds and other things, and high interest rates have affected and impacted them less than any of the other banks. They have by far the most capital and deposits in the entire country. So at this point, they're up there number one. And then you've got Citi that's up there. You've got Bank of America that's up there. Wells Fargo does have some losses, but they're still looked at as a pretty safe bank. So those are kind of the safest ones in terms of your odds of having issues. And so what's happened is this is hurting the smaller banks, the regional banks, and I'm not sure it's a good thing. It's kind of like when you look at like a Facebook or something like that has so much power, Twitter before Elon Musk, like they have more power than the government, honestly. And these big banks now have more power than the government. They have more power than the richest people in the world because they control so much. And so is that a good thing? It's not. But then on the other hand, it's not a good thing to have your money in Silicon Valley Bank. And we had friends who weren't going to be able to make payroll the next week because all their money was tied up in Silicon Valley Bank.
Yeah, I mean, when you talk about organizations getting bigger than government, I don't know if you saw this, but Apple is now launching a high yield savings where you can put your money in your Apple savings account and get like a 4% or 4.1 or something just remarkable. And it's scary to think if Apple is now
send
not
me
everyone's
that
phone,
link.
but
That
everyone's
sounds
bank.
good.
Like it's pretty impressive. And it's funny you mentioned Chase because this article actually talks about Chase and how Chase did a survey of 600,000 business accounts that they currently have and realized the median cash balance is just 12,100. And so you don't really need to be worried about losing your money if you've got 12 grand in there. It's like you mentioned, the second you surpass that $250,000, that 250,000, when the FDIC isn't going to essentially be able to give you your money back. And so, obviously if you've got more than 250,000, it may not be a bad idea to hold money with different banks, with different accounts. Like they talk about in here, payroll obviously is one of the biggest business expenses. And sometimes you can do payroll out of this account and hold the rest of your funds in another account. So diversifying is obviously an important move here.
So in this article, it says payroll cost, as you were saying, is one of the biggest expenses for most companies. Gusto, a payroll and benefits provider for more than 300,000 small businesses, said nearly half of its clients with 50 to 99 employees had monthly payrolls above 250,000. So if you're, one of those companies, 250,000 isn't a lot because just your payroll alone is $250,000 a month, not counting rent and overhead and marketing budgets and having excess money in there just for, any bumps in the road. And so it's those types of companies that have issues. But you're right. I mean, the vast majority of small businesses don't have that type of money, and certainly most consumers don't either. So for most of us, not a lot of worry there. But if you do have above that 250,000, then that's where you should think about, potentially opening up multiple accounts since FDIC will insure. But honestly, it does seem that it's very likely if there were another bank failure, and oddly enough, and you and I, we've talked about this, locally here in Utah, there's a bank called Zions Bank, and I think most people would say that they've done a great job of serving small business and families for a number of years. And they've been affected. Their stock was really getting hammered. And I think they did have some tech investment companies that their deposits were coming down and so forth. And so there are some really good regional banks that have been negatively impacted by these rates, probably just putting their money in long-term U.S. Treasury bonds and mortgage debt, and those probably have some losses. And so they're in a tough situation. But it looks like they're hopefully going to make it, and hopefully some of these others are. But tell us about some of the other options that are available.
Yeah, I mean, the first thing that they talk about doing is like we just talked about is kind of diversifying. Sometimes you can put money because a business account is insured separately than an individual or a personal account. And on a business account, Leo, if you're on the account and I'm on the account, it's still only $250,000. Yeah. With a personal account, if I add my spouse to an account, now that is insured by $500,000.
Oh, wow.
Because they count it as two separate individuals. So I mean, that's one of the options. This other one, this was new to me. Have you ever heard of IntraFi?
I have not, no.
So what it talks about is banks can mitigate risk through the IntraFi network. It's a system that can split a customer's large deposits into chunks that are less than the 250,000 cap. It then sends those chunks to other banks in the system, essentially giving customers multiple FDIC insured accounts. So it's kind of like a system that diversifies it for you, but you still get to interact with just your one bank, which is kind of interesting. That's something that you should definitely look into if you're the type of business owner that has more than that $250,000 at any given time, which was a kind of a unique opportunity there. And then again, should I be concerned? Should I be worried? That it's something that just comes down to how much money you're holding. I overall, no, I don't think that the vast majority of the banks are going to shut down and you're going to have any problems. But if you do have over 250,000, I would absolutely, just like you prepare for any sort of potential crisis, right? We keep food storage because of a potential massive earthquake in Utah. It may never happen, but mitigating your risk is a very, very important thing to do.
No question. And if you are in Utah or one of those areas where there's earthquakes, you should have earthquake insurance.
Absolutely.